The Japanese yen has been sliding fast against the dollar in recent years. Here's a graph to show you just how much it slid against the dollar since 2020. As you can clearly see, the yen has depreciated in value against the dollar from approximately 100 yen to a dollar in 2020 to over 150 yen to a dollar as of the latest value. It even once reached over 160 yen to a dollar in June of 2024. Some of you might think that this is bad, right? A sliding yen, after all, means that goods and services are going to be cheaper in Japan for foreign tourists. If you visit Japan and spend money there, you're bound to save a lot compared to previous years. With the yen weakening from 100 to 150 yen per USD, the same amount of dollars now buys significantly more yen, making purchases in Japan comparatively cheaper for foreign visitors. Whether that is food, electronics, and whatever else there is to buy in Japan. You might think this is bad for the Japanese economy, as a weaker currency often signals economic challenges. One of the ways you can even see this is through the gross domestic product of Japan. Here's a graph with data that we collected from the World Bank. As you can see, the nominal GDP of Japan has gone down drastically since 2020, despite the fact that it reported growth in 2021, 2022, and 2023. This fall is largely because of the weak yen. Whenever a country's currency declines, it reduces the value of its GDP when measured in international terms, particularly against stronger currencies like the US dollar. But let me tell you why it's actually the exact opposite. A weak yen isn't really bad for Japan. Sure, there are reasons out there that showcase how a weaker currency is bad for a country, but it's actually good for Japan, and here's why. The first reason can be traced back decades ago. Back on September 22nd, 1985, a gathering occurred in the Plaza Hotel in New York City. The participants were the G5 nations, United States, Japan, West Germany, France, and the United Kingdom. And there they signed what was known as the Plaza Accord. The Plaza Accord was an agreement that aimed to address the significant trade imbalances of the time, particularly the United States' growing trade deficit with Japan and West Germany. Here's a graph to showcase just how bad the trade deficits were from the United States. This graph is the current account balance, BOP, in current US dollars. A current account balance shows the difference between a country's exports and imports of goods, services, and capital. A negative balance, or a deficit, means the country is importing more than it is exporting, while a surplus means the opposite. As you can already tell in the graph, the current account balance of the United States was dropping fast between the years of 1982 to 1987. This suggests that the United States was facing a growing trade imbalance during this period, with imports far outweighing exports. And it was known back then that Japan, along with other nations like West Germany, were the beneficiaries of these. You can tell that from the total reserves of Japan itself. You can see from 1960 to 1988, Japan's total reserves skyrocketed from $1.95 billion to a massive $106 billion. And an important reason for this rise in Japan's total reserves was because of its export-driven economic model. They were basically exporting so much goods to the entire world, ranging from its automotive sector, driven by companies like Toyota, and its electronics industry, driven by companies like Toshiba. Now, the Plaza Accord was aimed to balance all these. The results of the Plaza Accord after it was signed was that Japan's national currency, the yen, appreciated sharply against the US dollar. Here's a graph with data published by the World Bank on the official exchange rate per year. You can already see that in 1985, the yen was trading at 238 yen to a dollar in that year, and after it was signed, it plummeted to over 168 yen to a dollar in 1986, and further down as years went by. The reason why they wanted to appreciate the yen in value was because of all these trade deficits incurred by the United States. But the results were actually tragic, very tragic for Japan. How so? Well, the first reason is simple and easy to see: exports. Japan was exporting a lot of goods to the United States, and a simple reason why they were exporting successfully was because their goods were cheaper to buy than US-made products. And that's because their yen was trading at such a low value compared to the dollar. A weaker yen, after all, meant that Japanese goods were more affordable in international markets. For instance, if you were to buy a Toyota car in the 1980s when the yen was cheaper, the price difference compared to US-made cars would be significant. For example, a Toyota car manufactured in Japan that would cost 1,500,000 yen in the 1980s, and at an exchange rate of 240 yen to $1, which was prior to the Plaza Accord, would only cost $6,240. However, after the Plaza Accord, the yen appreciated sharply. Let's say the exchange rate changed to 120 yen to $1. That very same car would now cost over $12,500, which is double the price. This means that Japanese companies are now less competitive compared to other companies. These impacts were then one of the causes for Japan's economic decline on the world stage. They could no longer compete against countries that could provide cheaper goods. This is why, if the yen were to become weaker, if it were to go back to 150 to 160 yen, or even 200 yen, it would actually be good for Japan. This will make Japanese companies more competitive. This will allow companies like Toyota, Sony, and Panasonic to regain a competitive edge in international markets, boosting their revenues and revitalizing Japan's export-driven economy. Now, that's not the only reason why the yen being weak is better for the Japanese economy. There's another important reason, and that's tourism. Foreign tourism contributes a lot to the Japanese economy. Here's a graph of the Japanese visitor arrivals by year with data published by the Japan Tourism Statistics. The data here, however, had obviously been damaged by the COVID-19 pandemic. But one of the key reasons why the tourism industry has bounced back big and fast is because of the cheap yen. As we also mentioned at the start of the video, a cheap yen is good for the international tourism of Japan, as it makes travel to Japan more affordable for foreign visitors. When tourists convert their home currency to yen, they get more value for their money, allowing them to spend more on accommodations, dining, shopping, and cultural experiences. This influx of foreign spending directly supports local businesses, boosts employment in the hospitality and service sectors, and contributes to Japan's overall economic growth. Finally, the most important reason why a weak yen is good is because it stimulates inflation. Yes, inflation might not be a famous concept that many people see, but in Japan, it's actually needed, and that's because the country has been plagued with deflation not just for years, but for decades. Here's a graph of Japan's inflation, consumer prices annually as reported by the World Bank. You can see that from the 1990s to 2021, inflation has either been at less than 1% or even negative. It was only in select years like 2014, 2008, and 1997 that inflation rose to more than 1%. Yet, as you can see in both 2022 and 2023, inflation had finally picked up to 2.5 and 3.3%, respectively. This was something Japan needed for years, as deflation is often blamed for its prolonged economic stagnation. Deflation discourages spending and investment, as consumers and businesses delay purchases in the hope that prices will drop further. This vicious cycle reduces economic activity, shrinks corporate revenues, and places downward pressure on wages. Then, one more reason why the stimulation of inflation is good is because of Japan's debt. As the world's largest holders of government debt to GDP, as you can already see from this graph right here, Japan's economy might be in a bad position in the future. But if inflation were to rise steadily, it would erode the real value of Japan's massive public debt over time. This is because inflation reduces the purchasing power of money, meaning that the debt becomes less expensive to repay in real terms. For a country like Japan, where public debt exceeds 250% of GDP, this is a critical benefit of moderate inflation. But then again, we didn't really mention how a weak yen actually stimulates inflation. It does so through several key mechanisms, primarily by increasing the cost of imports. Japan relies heavily on imported goods, particularly energy, raw materials, and food. When the yen weakens, the prices of these imports rise in yen terms. This higher cost is passed down to businesses and consumers, causing overall price levels in the economy to increase, effectively driving inflation. But anyway, do let us know what you think. Thanks for watching.